Okay, let's just jump right into this explainer. If you're gearing up for the CIRE exam, specifically Element 7, you are going to want to lock in right now. We are zeroing in entirely on Know Your Product, or KYP. Now, the main goal today is simple. We need to break down all types of securities products. And look, getting a firm grip on this whole universe isn't just about memorizing facts for a test. It is literally the absolute bedrock for making informed investment decision-making in the real world.
But hey, since we are talking about the test, 21, that is the magic number. This single chapter carries a massive weight of 21 questions on your exam. Think about that. Nailing this section is absolutely non-negotiable if you want to pass, and mastering these products is going to be your biggest advantage on exam day.
So how do we tackle this? Well, to organize this massive universe of products, we're going to take a walk through a financial grocery store. We'll set up a universal framework and then stroll down 3 distinct aisles: raw ingredients, packaged solutions, and the high-risk alternatives. Then we'll wrap up with the tax hierarchy and the ultimate suitability test.
All right, kicking things off with our first section. Before we even step foot into that first grocery aisle, we've got to arm ourselves with the right lens. You need a reliable way to evaluate absolutely any financial product you pull off the shelf.
And here is your secret weapon, a simple 3-step universal framework. Step 1, evaluate the primary features. Step 2, identify the key risks. And Step 3, determine the tax treatment. Seriously, if you apply this exact features, risks, and tax framework to every single item we cover today, locking in those 21 exam points is going to be an absolute breeze. It just completely demystifies even the most complex products out there.
So let's see how this actually builds. Welcome to aisle 1. This is where we find the raw ingredients of any portfolio. Basically, we're looking at the direct ownership of individual equities and fixed income securities. Now, the core trade-off in equities is brilliantly illustrated right here. Think about common shares on one hand. They give you unlimited growth potential and a voice, meaning voting power, at the annual general meeting. But the catch, you are dead last in line if the company goes bankrupt. On the flip side, preferred shares make a trade. They sacrifice that unlimited growth and the voting rights, but in exchange, you get priority. You get a fixed, almost bond-like dividend and a much better spot in line if the company is liquidated. Moving down that exact same aisle over to the fixed income shelf, notice how we trade safety for yield. A Government of Canada bond gives you literally zero credit risk since it's backed by the feds, but, it pays a lower yield. Corporate bonds, though, are issued by companies to raise cash. They're going to offer you a higher yield, sure, but they introduce credit risk, meaning the company could actually default on its debt. And keep in mind, both of these carry interest rate risk. When rates go up, bond prices go down. It's like a seesaw. Okay, so using our framework, let's test your muscle memory right now with a quick rapid-fire scenario. What product offers a higher yield than a government bond, but carries the risk that the issuer's financial health could tank, causing a credit rating downgrade and a nasty price drop?
While if you said corporate bond, you hit the nail on the head. That credit risk premium is the exact key differentiator from a totally risk-free benchmark like a T-bill or a government bond. Understanding that specific risk trade-off is absolutely central to KYP.
All right, let's push our cart down aisle 2, packaged solutions. This is where those raw ingredients we just looked at are bundled together into professionally managed meals that give you instant diversification.
The whole ETF versus mutual fund debate is a classic. You are definitely going to see this on the exam. Check out the pricing differences here. ETFs trade intraday on an exchange, which means you know the exact price the second you hit buy. Mutual funds, they're priced just once a day at their net asset value, or NAV, right after the market closes. ETFs generally offer super low fees and great tax efficiency, making them perfect for your passive, cost-conscious investor. Mutual funds usually come with higher fees and lower tax efficiency, but they are fantastic for systematic savers using pre-authorized contributions, or if you're trying to access active niche strategies. Also hanging out in this packaged aisle, we've got a couple of unique items. First up, closed-end funds. Unlike mutual funds, they issue a fixed number of shares. Because of that, they uniquely trade at a premium, or sometimes a discount, to their net asset value, just based on market supply and demand. Then we have REITs, or real estate investment trusts. These are great because they let retail investors grab some exposure to income-producing real estate without having to go out and buy a whole apartment building. But remember this huge KYP fact. REIT prices are incredibly sensitive to interest rates. When interest rates shoot up, REIT prices typically fall right down. Moving right along, we're now entering aisle 3, the high-risk alternatives. Think of this as the specialty aisle. It is packed with highly complex products that are usually totally restricted to accredited or institutional investors.
These products, they demand extreme KYP diligence. Take hedge funds. They aim for absolute returns by using heavy leverage and short selling. Plus, they charge those infamous 2 and 20 fees. That's a 2% management fee plus 20% of the profits. And they are highly illiquid with strict lockup periods. Next, you've got crypto assets, largely unregulated, wildly volatile, where 50+% drawdowns are just a regular Tuesday and purely speculative. Finally, we have principal protected notes, or PPNs. These are structured products linked to an equity index that promise to return your initial principal at maturity, but they do that by capping your upside potential.
Now, pay close attention here, because the crucial point for principal protected notes is a very specific exam trap. If the issuing bank goes under, you can literally lose your money. Why? Because the Canada Deposit Insurance Corporation, the CDIC, does not insure structured notes. Your principal protection is literally only as good as the issuing bank's solvency. That is a massively important KYP fact to keep in your back pocket.
All right, let's step back from the product aisles for a second and synthesize everything. We really need to look at how the government takes a bite out of these returns in a non-registered account.
Understanding this tax hierarchy is absolutely essential for your exam, and honestly for real-world advising. Just look at the top tier here. Interest income from bonds or T-bills is the least efficient thing out there. It's 100% included in your income and just punished at your full marginal tax rate. Ouch. Moving down, Canadian dividends are actually highly efficient thanks to the dividend tax credit. But the absolute crown jewel of tax efficiency is sitting right there in the middle, capital gains. If you sell a stock or an ETF at a profit, only 50% of that gain is actually added to your taxable income. It's a total game changer.
Finally, let's bring this whole shebang together. This last section is where Know Your Product meets Know Your Client. It's the ultimate test of everything we've been talking about today.
Let's look at Maria's profile. She's 68, she has a low risk tolerance, and her main objective is capital preservation because she needs a stable monthly income. Crucially, her time horizon is short, just 3 years. Now, the proposed product for her is a balanced mutual fund with 60% equities and 40% bonds. Apply your new KYP knowledge to this KYC profile for a second. Is this suitable or unsuitable?
It is completely unsuitable. A 60% equity exposure introduces massive market risk. As we learned back in aisle 1, equities are volatile. If the stock market drops tomorrow, Maria doesn't have the time to sit around and wait for it to recover before she needs that cash in 3 years. This completely violates her explicit need for stability and preserving her capital. So I'm going to leave you with this final provocative thought to really test your mastery here. If you were Maria's advisor and that 60% equity fund was totally off the table, how would you rebuild her portfolio? Which specific, low-risk, capital-preserving raw ingredients from aisle 1 would you pull off the shelf to safely guarantee her retirement income over the next 3 years? Think about the features, the risks, and the tax implications of those safer products, and you'll be well on your way to totally mastering the KYP universe.